Welcome to our second and final presentation on bond valuations, bond yields. And in this presentation, we're going to find some interesting, well, kind of interesting things about bonds. Bonds are not that interesting to begin with, but we also might find some disturbing information. Yes, so let's get started on slide 20, yield spreads. The yield spreads are the differences in interest rates that exist among various sectors of the bond market. In the investment world, spread usually means difference. Remember the bid-ask spread? The shorter the maturity in general, the lower the rate. The longer the maturity, the higher the rate. That makes more sense, right? That makes sense because in general, the longer the money is out there, the more possibilities, opportunities for things to go wrong. And of course, the higher the rating of the bond, the lower the interest rate because they're a better credit risk. Just like when people go to the bank and have a bad credit rating, their interest rate's going to be higher. And if they're good credit rating, their interest rates are going to be lower. And then, of course, treasuries typically carry the lowest rates, with muni bonds being next, general obligation bonds being more desirable typically than revenue bonds, and then corporate bonds yielding the highest rates, non-callable bonds being more desirable, hence being able to pay less, have a lower interest rate, and callable bonds being the least desirable, and so paying you more. Okay, and so here, as of April 7th, are the yield spreads showing CD rates, by the way, and then Treasury, U.S. Treasuries, Treasury zeros. What are those? Remember zero coupon bonds? The Treasury doesn't really offer Treasury zeros. There's a wonderful type of Treasury called strip T's, stripped T apostrophe S, and you might want to look that up because it's kind of interesting. And we ask you to look some stripped mortgage-backed securities in the assignment in chapter 8. Now, the agency bonds, those are the Federal Fannie Mae, Freddie Mac, which are very similar to treasuries. And then we go through the corporate world and then municipal world. So notice that the yield spreads, as we say, are not that tight anymore. They were for many years, where treasuries were not paying that much less than corporate bonds. So you really weren't being paid very much to take on more risk. And we're going to see that that's changed because some of the corporate bonds are now paying a lot more. See, here's the Treasury, the 10-year Treasury, 3.4%, and corporate A bonds, 5.6%. So they're paying you 2% more. If you go down to the BBB, which is still investment grade, you're getting over 7% for the 10-year bonds. But notice, wait a minute, they start to go down after you get past 10, 20, 30 years. Why does that happen? Stick with us. Often investors will speak about the bond spreads as being tight or wide. A tight spread means the interest rates among the bonds they are evaluating are very close to one another. So a treasury might be paying 4.8%, corporate bonds paying 5.1%. That's a difference of 30 basis points. Normal humans just say 0.3%. No, but in the investment world, we have to act like we are more important than other people. So we give the name of 0.01% a basis point. The wide spread means there's a big difference between the bond interest rates, where a treasury might be paying 3.2% and corporate bonds paying 8.2%, and that would be 500 basis points or 5%. During the turmoil of the 2008 and 9 Great Recession, global financial crisis, the yield spreads widened to levels not seen in decades, because there was that flight to quality. Everybody rushed into treasuries and sold off their corporate bonds. And then during the 2010s, the spreads narrowed significantly to the point, as we said, you really weren't getting paid very much more for taking on a whole lot more risk, which turned out to be not such a good idea in 2022 because they've widened again. And as we said, experts in the media, and you will now be one of them, use the term basis point to signify 0.01%. 100 basis points would be 1%. Okay, so just get used to that because you'll sound really smart if you do that. Slide 23. The yield curve is a graph that represents the relationship between the bond's maturity and its yield at a given point of time. And it's also used to make comparisons amongst types of bonds. Normally, the yield curve is upward sloping, and longer-term bonds have higher interest rates than shorter-term bonds. And, of course, treasury bills and corporate paper. Sometimes the yield curve is downward sloping. It's called an inverted yield curve. Shorter-term bonds, treasury bills, corporate paper have higher interest rates, money market mutual funds, than longer-term bonds. That doesn't make any sense. Okay, let's take a look at the typical upward sloping yield curve on slide 24. You see, this is what we normally see. Is that what? That's somewhat a magenta or something like that? And that's the upward sloping, typically referred to as a normal yield curve. But every once in a while, we have a downward sloping yield curve. And what is that? Sort of like a burnt red or something like that. This is the inverted yield curve, the dreaded inverted yield curve. Why do longer-term debt securities normally have higher interest rates than shorter-term debt securities? Well, there are three hypotheses, and they all make sense. The shape of the yield curve reflects investors' expectations of future interest rates. Right, it's all about the future. And also the maturity preference hypothesis, or sometimes called liquidity preference hypothesis. Investors tend to prefer the liquidity of short-term securities and therefore are going to require a premium. You're going to have to pay me more to invest in long-term securities. Right, because there's more opportunities for things to go wrong. So yeah, you got to pay me more. Just like when you go and get a 30-year mortgage versus a 15-year mortgage, they're going to charge you less for the 15-year mortgage. And then lastly, the market for debt is segmented into various supply and demand markets for 5 years, 10 years, 15, because people have different time frames. And these all make sense, and they all have their merit, but how do we account for the times when the yield curve is inverted? What factors could cause an inverted yield curve to occur, and what can the yield curve tell us about the future of the economy? Bum, bum, bum. Slide 27. Since World War II, every time the yield curve has inverted, where short-term rates were higher than long-term rates, the economy has fallen into a recession. There was one exception, 1966, where it didn't go negative. It didn't reverse itself. It just hit zero and then started growing again. And the yield curve inverted in 2019 ever so slightly, causing renewed fears of an imminent recession. But COVID sort of took care of that. But now, as we're going to see, the yield curve is inverted again. One example was 2007, 2006, and 7. For about 2 years before the beginning of 2008, the yield curve was slightly inverted. So the bond market was predicting a recession for over 2 years. The stock market, for the most part, just didn't believe them. But I'll tell you, folks, I trust the bond market more than I trust the stock market. It wasn't until the fall of 2008, when the wheels were falling off the economy, that the officials charged with tracking the economy acknowledged, oh yeah, we're in a recession. It took over 2 years, but the bond ghouls, as they are called, were finally proven right. Just recently, the yield curve has inverted. Actually, I should change that. It's not slight anymore. It's pretty inverted here. So, is a recession ahead? So I'm going to change that. So it's because it's kind of inverted even more so the last couple of months. Why are they called bond ghouls? I don't like that term, but that's what you're going to hear in the industry, and it makes sense, but it's not a very nice name, is it? Well, what happens when there's a recession? Well, stocks get hammered, earnings fall, people lose their jobs. Not a fun time, but we know they're going to happen. What happens to interest rates? Right. The Federal Reserve Bank and other central banks around the world lower interest rates on the short term. Long-term interest rates fall. Why? Because there's less need for money. So there's less demand. And what happens when interest rates fall? Bond prices rise. So bond investors are often called bond ghouls because supposedly they love it when there's a recession. I don't know any bond investors who love a recession, but that's what you're going to hear. Slide 28. Here's the yield curve in 2019. Notice it was slightly inverted. Not that much inverted, but just slightly inverted. And there was much talk about a coming recession. Of course, this was the year before the presidential election, and no president wants to enter a recession in an election year, where they're going to be running again for election. But in this case, it was all moot. It was all moot, M-O-O-T, because COVID hit, and the Federal Reserve Bank and banks around the world collapsed short-term rates. Long-term rates fell as the bond investors braced for a pandemic-induced recession. So this was an example of where the inverted yield curve didn't really get a chance to prove itself. COVID did it for it. COVID did the job for the inverted yield curve. But now let's take a look at today's inverted yield curve, and it's more inverted than it was just a few months ago. So we got to change this here. Notice that the short-term interest rates here go up a little bit between 1 month and 3 months, but then start falling, not dramatically, but still it's inverted. And when the yield curve inverts, the investment world begins to worry about a coming recession. Are we heading for a recession? Well, the problem is you won't know until you're halfway through it or all the way through it. Look, keep a long-term perspective. Recessions come and go. Focus on high-quality companies with growth and income prospects. And whatever you do, don't panic. And recessions often are excellent times for people to pick up companies that their stocks have been clobbered, right? As Peter Lynch says, a recession is just like a storm in the winter. In Denver, you know it's going to happen. You know there's going to be snow falling, and you just got to hunker down and be ready for any opportunities for long-term investments. Okay, enough of the commercials. Slide 30. All right, so that was bond yields, bond curve, the yield curve, bond yield curves, and what it can predict for the future. Now let's look at something that we have more control over, and that is the bond valuation, at least our predictions for the bond valuations. Bonds are normally priced according to the present value of their future cash flows. I certainly hope that sounds familiar, because what we're going to get are semi-annual interest payments. Remember, they typically pay us every 6 months. Some pay more often, but we're going to stick with every 6 months. And then we get our principal back. So this is going to look very familiar, dear students. Right? Present value of the future cash flows? Yeah. Although other factors will always need to be considered, such as the credit worthiness of the issuer. If an issuer runs into trouble, the price of their outstanding bonds will fall because investors will be afraid of default. So in Chapter 8, we saw where people were dumping the bonds of Ford bonds and Poway bonds because they were Poway School District, because they were so frightened that the that the entities would go into bankruptcy and not be able to make their payments. Yeah. So here is the formula for our prediction for a bond valuation. It is equal to the present value of the interest income and the present value of the repayment. So this is the exact same model we use for stocks. But instead of interest income, we use dividend income. And instead of the principal repayment, we use the predicted price of the stock in 3, 4, 5 years. Now, bonds are fixed. So what happens is we know, unless there's a default, which is very rare, but it happens, we know what kind of interest payments we're going to get. And we know what the principal is going to be. So it's going to turn out that these predictions are far more accurate for the price that one would pay for the bond. Yep, bonds are boring. Now, one thing that we're not going to worry about, because we're not computers, is the difference between annual and semi-annual compounding. Since bonds pay interest normally every 6 months, we really should be using semi-annual compounding. However, annual compounding is much easier to compute for we humans and will give you almost the exact same answer. So what difference does it make? A few dollars off. Computations are easily done using the present value tables, and the spreadsheets make it easier. So, of course, we're going to have a spreadsheet out there, and there's a little presentation to show you how to use the spreadsheet. So let's take a look at an example. And we picked this example precisely because the yield to maturity was so close to an integer. And we'll see why, because that we humans are not computers. So it's actually paying us 5.5%, which is $55 a year. But notice that its price was higher than $1,000. So its yield is less. And of course, we've learned how to do those calculations. The current yield is 5.291%. It's rated A minus, so it's investment grade. And since that's why I picked this bond, because 4.994% is close to 5%. So we're going to use 5%. It's due in a little less than 10 years, because we've already moved into April, but we're trying to make it as close to 10 years as possible. And we're going to see why. Because we're going to do the exact same thing manually that we did with stocks. We're going to use present value tables. So on the website and in Canvas, you will see these present value tables for Chapter 9. Now, they are multiple. There are 2 of them. Actually, the one on the right is the exact same table we used back in Chapter 4. It's the exact same table because it's the present value of a lump sum investment. And remember, we did the calculation for the dividends in year number 1, and the calculations for dividends in year number 2, and the calculations for the dividends in year number 3. Well, now, the dividends were changing. For bonds, the dividends are the same, and we do that for 10 years or 20 years or 30 years. So that's going to be a real pain in the patootie. We're going to have to do 20 different calculations? No. What we do is we create a table that gives us the exact same idea, but instead of single payments every year, it gives us a present value multiplier for a stream of payments. Now, why are these guys highlighted? Because this is the problem in the worksheet number 1 that you're going to go through. And of course, there's answer keys and commentaries. But we're interested in 5% for 10 years. Okay, it's hard to see the 10. I apologize. It's right over here. There's the 10. It's hiding. So this is the present value multiplier for a stream of payments at 5% for 10 years. Because we know this bond is going to be paying us. So let's remember that number, 7.722. Okay. We know this bond is going to be paying us $55 every year for the next 10 years. So that's the present value of the interest income. We take the $55 we're going to get every year for the next 10 years, and we multiply it times 7.722. Well, what's that equal to? Well, if you use your calculator, make sure I got it right. That's equal to $424.71. Now, it's easy to understand that if we get $55 every year for the next 10 years, that's $550. But we know that there's this time value of money calculation we have to do. We have to bring that $550 back to the present. And that $550 we're going to get that $55 we're going to get every year for the next 10 years is worth to us today $421.71. So hopefully this is clicking. Hopefully this is making sense, because this is exactly what we did in chapter 4, but we did it for stocks. But now we're doing it for bonds. And because bonds are fixed, unless Idaho Power Company goes bankrupt, we know we're going to get the $55 for the next 10 years. All right. And at the end of the 10 years, we're going to get the $1,000 that the bond was originally sold for. And so what's that worth to us? Well, that's a single payment. And so we go back to the table and we find that this table over on the right, this is the same table as chapter 4. We go across the 5% down 10 years and we see 0.614. Are you with me? Make sense? I hope so, because this is exactly what we did with the stock prediction, the stock price prediction. But with bonds, there's no prediction unless the Idaho Power Company goes out of business, which is probably not going to happen. We're going to get $1,000 in 10 years. And what is that worth to us today? 1,000 times the present value multiplier for 5% in 10 years for a single payment of 0.614 or $614. We add the present value of the interest income plus the present value of the principal repayment, and we get approximately $1,038.71. Well, if you go to the FINRA website, by the time you look at this, it's probably changed because prices change every day. It was $1,039.49. Pretty darn close, right? Now, on the bond calculator, which is more precise, it gives us $1,039.02 for annual payments and $1,043.02 for semi-annual payments. So wait a minute. If we're doing this as precise as possible, shouldn't the price be $1,043.02? Well, investors are saying, I'm going to knock a few bucks off because it's only an A minus or whatever was happening that day, right? Somebody just decided to dump their bonds. Why is the semi-annual payment prediction higher? Well, because we're getting money every 6 months. We're not waiting until the end of the year. But the two are, what's a few bucks of one another, so what difference does it make? But you understand that because we're getting the money, we're getting half of the $55 every 6 months. We're not waiting until the end of the year. That's why it's worth a little bit more when we do the precise calculation. And of course, now go to you can take a break now if you want, or later on, take a look at the spreadsheet, the presentation for the spreadsheet, which you can use. Now, we want you to do the worksheets manually first so you understand what's going on, and then go right ahead and use the spreadsheet, because the spreadsheet does make life so much easier. Okay, now we have a few odds and ends to wrap up, and then we'll be done with bonds. Reinvestment risk. What's this? Let's think about this, folks. The reinvestment risk is the uncertainty about the future value of an investor's bond investments that result from the need to reinvest bond interest payments and redemptions at yields not known in advance. Huh? Well, stick with me here. Changing interest rates don't only affect the price of your bonds. I mean, think about it, right? You have a bond and interest rates fall. Cool! Your price of your bond goes up. You have a bond and the interest rates go up. Oh, the price of your bond went down. But don't worry, because you're getting your interest payments and you're getting your principal payments. So the change in the interest rates doesn't only affect the price of your bond, It also affects your future income as you need to reinvest those interest income and bond repayments. If interest rates have fallen, cool, my bond price has gone up. But now your income level will fall as you reinvest your income and bond repayments. Likewise, if interest rates have risen, although bond prices have fallen, your future income level will rise from reinvesting in higher paying bonds. And folks, again, this is just another perfect example of why it is important to keep a long-term perspective if you are a buy and hold, prudent, long-term oriented investor. Of course, if you're trying to play the interest rate game and buy bonds right before interest rates fall and sell them before interest rates rise, I wish you a lot of luck and I hope you're successful. You're going to need a whole lot of luck because, as we saw, there's a article. It's a few years old, but it shows how 100% of all economists who were polled couldn't predict what happened with interest rates. There are people who are paid tremendous sums of money to incorrectly predict where interest rates will go. Can you imagine how well they would do if they really knew, if they really could accurately predict them? Duration. Now, this is something that for the vast majority of us, I'm going to ask you on the exam. Okay, all right. But it's not that important for the vast majority of us because normally we don't have millions of dollars to invest in bonds. It's more important for mutual fund managers, pension fund managers, institutional managers, and people who have a whole lot of money. Duration is a measure of the bond price's sensitivity to changes in interest rates and bond yields. This captures both the price risk, interest rates going up and down, and the reinvestment risk that we just looked at on the previous slide. It's used to indicate how a bond will react in different interest rate environments. The duration of a bond changes as it approaches its maturity date and interest rates change. In general, the longer a bond's maturity, the longer its duration. That makes sense. But the higher the bond's nominal rate and yield to maturity, the shorter its duration. And of course, the shorter the duration, the less potential price volatility. The longer the duration, the more potential price volatility. And so, on slide 35, they've come up with this idea called immunization. Whoa. Investors who have a specified time horizon can use bond immunization, like a virus or something, to increase their probability of successfully achieving their desired goal. The idea is you keep the average duration of your bond investments equal to your time horizon, and then you would thus be more protected against interest rate-induced price swings. In other words, if you need this money in a year or two, you don't want a 30-year bond in your portfolio. It requires constant rebalancing of your bond portfolio since durations of bonds change as interest rates change and bonds get closer to maturity. Now, again, you and I do not have millions or hundreds of thousands or whatever. We're not going to be owning that many bonds, but mutual fund managers, pension fund managers, life insurance companies, they need to use these techniques, and we're not even going to learn how to do them because they're not that important to us. Slide 36. What are the three major bond investment strategies? Well, there's the income strategy, which is, I think the best and the easiest. You buy the bonds for the income, right? There's the capital gains, which is more speculative, where you're guessing, estimating, speculating, gambling, where interest rates will fall. And many people will jump into the junk bond market when they believe interest rates are going to fall or the credit quality is going to rise, because you can make some serious capital gains in that when that happens. And of course, there's the mixture of the two, the total return strategy, where you're buying your bonds for income, but you're also looking to juice your returns with capital gains. And you will often see a mutual fund called the Total Return Bond Fund, where you know that these people are doing their best to give you income and also give you some capital gains. Obviously, the income strategy is the easiest. The capital gain strategy is the hardest to implement, and the total return is somewhere in the middle, depending on your individual situation. Now, slide 37, bond laddering. It's a fancy word for diversification. You buy bonds with staggering maturities. You purchase some short-term bonds, intermediate-term bonds, long-term bonds. Again, this is more popular with pension funds, bond mutual fund managers. Why? Because they got tons of money. And what are the advantages and disadvantages of this strategy? Well, the advantage is you're diversified. And the disadvantage is you're diversified. Diversification is a two-edged sword. But in general, in my humble opinion, and many long-term prudent investors, diversification is a good thing. And we'll discuss diversification in more detail very soon when we get to chapter 11 and tie everything we've learned together. Slide number 38. Here's a here's a ladder, bond investment ladder. And this is right before interest rates started to rise. Notice the 3-month treasury, the 6-month treasury, the 2-year, they were paying next to nothing, folks. And look at the spread between 10-year treasury and 10-year corporates. Not very big at all. A little bit bigger between the 30-year treasury and the 30-year corporate, but still, interest rates were very low, and many bond investors were striving for yield, reaching for yield. They were going with very risky bonds just to get a few more percentage points out of their portfolio. Or they were putting short-term money, which was earning next to nothing, into longer-term money with disastrous results. That's how Silicon Valley Bank got in trouble. They were juicing their returns by taking that short-term money that they needed for the deposits and putting it into long-term bonds. And of course, in 2022, the price of the bonds fell as interest rates went up, and they were in trouble. And the thing is, folks, why did the regulators let them do it? That's the thing that drives me nuts. Just so the banksters could pay themselves a bigger bonus that year. It's just not right. I don't know where I'm often accused by the industry of being a fuddy-duddy and a old-fashioned, but you know what? Banks are not supposed to be exciting. Banks are supposed to be boring. So let's see what happened in April of 2022 as the Federal Reserve Bank started saying, you know what? We got to get serious about this. They started raising short-term interest rates, and we see the longer-term interest rates going up. But still, it wasn't that, a little bit wider between the 10-year Treasury and the 10-year corporate and the 30-year Treasury. They're not that much wider, but watch what happens when we go to today. Now we see short-term rates very high compared to what they've been. And people are sitting around looking at their CDs and going, hey, looking at their money market funds and going, wow, I'm getting 4.5%. Notice how much wider the spreads are now between the 10-year Treasury, 3.4, and the 10-year corporate, 5.6, more than 2%. And the same thing here between the 30-year Treasury and the 30-year corporate. And notice that the yield curve is falling. The yield curve is inverted in some cases. Look at this. The 10-year Treasury is 3.4. The 6-month Treasury is 4.8. As I've said, I trust the bond market more than I trust the stock market. I think we're heading for a recession. But folks, I ain't selling anything. I'm not going to do anything differently. I still have even though I should because I'm kind of old. But I believe the next 5 to 10 years are going to be awesome for the economy. Maybe not so much for stocks because they're already pretty expensive. But still, I'm very, very optimistic. If we don't have World War III, which, oh well, we here in San Diego will be vaporized, and so we won't have to worry. And it was attributed to Nikita Khrushchev, he of the Cuban Missile Crisis fame, we don't know if he actually said it, but the saying is, the living will envy the dead after a nuclear war. So on that happy note, we are finished with bonds. Yippee! Boring bonds, stodgy bonds, reliable bonds. So make sure you do the worksheets 1, 2, and 3, especially 3. There's a commentary, answer key. Do them over and over again, and then play with the spreadsheet, which makes life a lot easier. Because in our next chapter, we're going to take a quick look at what are called hybrid securities. They're really not that popular. They're really not that useful for most of us retail investors. But since you are the official investment gurus for your friends, family, and coworkers, you have to be able to at least explain to them that no, you don't want preferred stocks. You want common stocks. I know common stocks sounds just bleh, but you don't want preferred stocks. You want common stocks. Cool? Okay. See you in our next chapter. Hybrid securities, preferred stocks, and convertible securities. Do those worksheets, dear students. Worksheets 1, 2, and 3. Contact me if you need help. We are so proud of you. Think about how much you have learned. You are awesome.